In the 1970s, when the US was grappling with high inflation, two brothers, Nelson and Hubert Hunt, decided to take an audacious bet that would send silver prices soaring through the roof. I mean from $6 an ounce to $48 an ounce. The Hunt brothers were convinced that high inflation would reduce the value of investments linked to the strength of the dollar as a currency. It all started with H.L. Hunt, an oil tycoon. Died in 1974. He left his billion-dollar legacy to his family, which included his sons Hubert and Nelson. The Hunt brothers felt that inflation would drive silver to become a haven similar to gold. Nelson was particularly concerned that inflationary pressures would wreak havoc on any paper-based assets. The Hunt brothers allegedly purchased more than 35 million ounces of silver, some of which they flew to Switzerland in specially designed aircraft guarded by armed Texas ranch hands. By accumulating silver and utilizing their vast financial reserves to purchase even more, the billions in demand drove the price of silver to soar to slightly more than $50 per troy ounce by 1980. The Hunt brothers made $100 million for every dollar that the price of silver increased by. And silver was hot, fiercely hot. Grandmothers were selling their silverware, robbers were stealing both gold jewelry and silver goods, and the silver fever spread from coast to coast. The Hunt brothers had a simple investment thesis. They believed silver was undervalued in comparison to gold, and that owning silver rather than US dollars would act as a hedge against impending hyperinflation. The brothers thought that without the gold standard, the government would continue to issue money at an increasing rate to cover its expenses, resulting in severe inflation.
When the price of silver shot up toward $50 an ounce last year, Americans lined up in thousands to sell their silver bowls, candlesticks, knives, and forks to be melted down into bullion.
Another option would be to acquire gold. However, the Gold Reserve Act, implemented by the Roosevelt administration in 1933 and not repealed until 1975, made it unlawful for anybody other than the government to own gold. So the Hunt brothers resorted to the next best metal, silver. Over the course of the decade, they purchased tens of millions of ounces of silver. As the decade progressed, the brothers were interested in a new financial tool that would enable them to purchase even more silver: derivatives. However, the sharp drop in silver prices in January 1980 had a negative influence on their financial status and capacity to make brokerage margin calls. A futures contract works like this. Assume you want to buy silver because you believe the price will rise. You may not want to deal with accepting physical delivery and storing it in a vault. Instead of buying silver and transferring it from my vault to yours, you might purchase the right to buy silver from me at a later date. Since you're betting on the price of silver, you want to lock at current prices so that you can buy it at a discount later when the price rises. So I sell you the right to purchase 1 million ounces of silver at $10 per ounce in 3 months' time. When the future expires, you must pay up and accept delivery of the silver. Futures contracts are useful because they allow you to apply massive leverage. Instead of purchasing $1 million worth of silver for $1 million, you can purchase the right to purchase $10 million worth of silver in the future for $1 million. This is because purchasing the futures contract requires only a little percentage of the final purchase price of the silver, 1 million out of 10 million, or 10%. The little 10% deposit is known as the margin and will play a significant role in the Hunt brothers' story. Typically, futures contracts are settled in cash. The differential between the price at the start of the settlement and the price on the day of expiry. But the Hunt brothers, instead of squaring up their positions, chose to take delivery of silver. This relentless buying started pushing silver prices higher, all the way to $50 an ounce from $11. As their inheritance money began running out, the brothers started buying silver using borrowed money. Because of the family's strong credentials, they were able to borrow money at below market rates of interest. If the price of silver rises to $15 per ounce in 3 months, you can buy it for $10, sell it, and keep the difference. If you purchase $10 million in silver futures, you can make $5 million on your $1 million investment, representing an astounding 5 times the return. This is considerably larger than the 1.5 times profit that might have been earned by merely purchasing silver outright. Towards the end of the 1970s, the Hunt brothers developed a strong interest in these trades. They began purchasing futures contracts at a staggering rate. In many situations, the Hunt brothers were not even required to put down the 10% margin on their futures trades. Instead, they were able to persuade banks to promise on their behalf that the margin funds would be accessible if needed. What is the cost of such a letter of credit? Only 1% of the value of silver in the futures contracts. This method enabled the brothers to make large gains from a slight increase in the price of silver. However, if prices fell even a little, they risked losing all of their money. For most investors, that's where the story of futures and forwards stops. The price of the commodity is nearly entirely determined by other market participants. Therefore, the bet placed with the futures contract is mostly dependent on their actions. However, the Hunt brothers were so wealthy that they could have a substantial impact on silver prices by themselves. So, while they weren't rich enough to buy all of the world's silver, they were wealthy enough to purchase approximately half of it. With that level of control, they could compel people who utilized silver for industrial purposes to buy from them at exorbitant prices. They may almost corner the market. To increase their profits, the Hunts formed a partnership with 2 Arab sheiks and a group of anonymous investors working via a Swiss bank, all of whom began buying silver. As prices soared, they used cash settlements from futures contracts to fund the margin required to get new letters of credit from banks in order to launch additional futures contracts. By the time silver peaked, the Hunt brothers held 195 million ounces, accounting for roughly 1/3 to 2/3 of all silver mined in the world at the time. People began to notice. The enormous surge in silver prices was not lost on the general people. Tiffany & Co., the famous New York jewelry company, ran an ad in the New York Times criticizing the Hunt brothers and other silver speculators. Carried away by their initial success, the brothers began approaching investors outside the US and made a strong case for investing in silver. The audience included investors from Saudi Arabia as well. The brothers were able to successfully sell their story to raise money, which again went into buying more silver. As silver prices climbed, many traders began to short sell silver futures, confident that the high prices would not sustain. Thanks to borrowed money, as well as that raised from global investors, the Hunt brothers were able to buy whatever the bear traders in silver were dumping. As prices remained high, short sellers had no choice to start covering their positions by buying silver at whatever prices they could get it for. This pushed silver prices higher as it attracted other buyers looking to make quick money from the rising silver prices. At one point, the value of the silver positions amassed by the Hunt brothers was worth $4.5 billion, or around $15 billion today. People began pawning or selling their silverware and coins to cash in on a frenzy in silver prices. All of this interruption irritated some very significant people. Among these was the CFTC's chairman, James Stone. Stone was concerned and began pressuring brokerages to boost margin requirements for silver futures and forwards, and he pushed banks not to lend more money to the Hunts. But it wasn't enough. Prices continued to grow during the new year, reaching a peak of $50 per ounce, or $184 in 2023 dollars. At this moment, the exchanges, prompted by Stone, began to take severe measures to prevent silver speculation. Down payments to control contracts were raised dramatically. No one was permitted to add to his position, and big holders were ordered to begin a steady dismantling of their holdings. At the same time, the Federal Reserve was raising interest rates sharply in an effort to combat double-digit inflation. During the bubble's peak, from January 1979 to February 1980, the Fed raised interest rates from 10% to 14%, making borrowing much more expensive. These factors combined to drastically limit Hunt's capacity to buy silver, causing prices to bounce wildly for the following few months. On March 27th, often known as Silver Thursday, the Hunt brothers failed to meet a $100 million margin call to Bach brokerages. resulting in a 49% collapse in silver prices in one day. Eventually, the US government had to step in. It saw the Hunt brothers' actions as an attempt to manipulate the nation's silver reserves, and seeing the involvement of investors from the Middle East made the authorities madder. That is, because just a few years back, the Middle East countries, led by Saudi Arabia, had been instrumental in pushing up oil prices, which resulted in the US economy being hit hard by inflation. Soon, the regulators scurried to introduce rules to prevent long-position contracts from being written or sold for silver futures, suspending the market fundamentals. Though, it did stop Hunts from increasing their position. With long positions frozen and short sellers continuing to attack, silver prices started to weaken. And suddenly, the Hunts became the hunted. As prices kept falling, the Hunt brothers were swamped with calls from brokers asking them to deposit additional funds towards margin. The shoe was on the other foot, and the Hunt brothers were paying millions of dollars in margin calls, storage fees, and interest. They finally managed to arrange a private bailout from a consortium of banks and companies. They were then dragged in front of Congress, scolded, fined, and forced into bankruptcy. It took them over a decade to unwind their silver holdings and satisfy the creditors. Some say, even though they were left billions more destitute, they were wealthy by most standards.